So now we are getting to stage 4, game plan A. So very excited to cover this because this is the most important part in this course of game of investing. The real fun is game plan A, which is picking stocks directly. It's a do it yourself investing where you go and pick stocks directly in the markets, create a portfolio, but you are not going to do that without understanding the fundamental analysis. You're not going to do that without understanding the market sentiments. You're not going to do that without doing business analysis and thorough analysis. Here, what I'm going to teach is fishing, but at the same time, you're going to learn how to do that process, right? It is not only learning how to do theoretically, how to analyze stock and how to pick stocks. In this course, as part of your membership, I'm also creating a practical portfolio because what is not covered really out there is most of the courses they cover theoretically and leave the users or in customers or investors on their own to go and do the picking of stocks. But I'm going to hold with a group of hand-picked stocks by me with deep analysis, as well as, you're going to be with me in this journey for the next foreseeable future till you're satisfied. I'm going to create that practical portfolio as part of the same membership what you've taken. Everything within is covered in the portfolio in the platform with that membership. So you're going to see that practical portfolio after this course, see how the analysis is done by me. Again, I'm not saying I am accurate, I'm perfect in that. I might make mistakes, but the good thing is you will learn from my mistakes too. I'll also learn. It's a group journey. We're going to be in this journey together. I'm going to have a practical portfolio of 15 stocks or 20 stocks at any point of time. And you will see how I analyze stocks, how I make buying and selling decisions, because these are not covered in any courses. So you need to have that practical hand holding. I'm going to come in the quarterly webinars we're going to have, and I'm going to present different things, different concepts. At the same time, I'm going to walk through how to handle this portfolio, what we're creating, right? Whether you want to, is it time to sell, call it sell? Is it time to ring the bell? Is it time to book the profits, or is it time to add more to the stock? How do you see from the future prospect, the addressable market changing? How is the business dynamics changing? You're going to see real practical portfolio management with me in this journey. So it's not only theoretical course. Now, what you're going to learn in this game plan A and game plan B is, game plan A is do it to yourself investing, where you're going to pick stocks directly. If you find this course boring during the journey of picking stocks or fundamental analysis that you're going to do, or business analysis you're going to do, if you find it not interesting or too tough to digest or too complicated, complex, and you think it's not for me or it's not for you, and or you find no time to do all this analysis, say you go through this course and you think, no man, this is like too much for me to do analysis. I don't have the time and luxury to do that. In such scenarios, this course, game plan A might not be applicable to you, but I would still urge you to attend this game plan A course. But otherwise, in between, if you're finding it, no, this is not apt for me, feel free to go to game plan B, which is stage 5, right? Which might be perfect for you, but it's a longer path. Game 5 is a stage 5, or game plan B is a longer path. This one right here, game plan A, is a shortest path to financial freedom in investing, but it is not easy. Let me start here like this. Investing in stocks is a combination of art, science, math, physics, market sentiments, emotional, behavioral, combination of multitude of things. But primarily it's a combination of art and science. So there's a lot of perception related aspects, as the beauty is in the eyes of beholder, valuation, fundamental analysis, all of that is in the eyes of the stock person who's analyzing the stock, or the eyes of the investor per se. So it cannot be taught theoretically and leave you like, you go and start investing. You can do it, but your learning curve will be longer, steeper, and also you will do more mistakes. What I'm trying to help you here is to enable you to make less mistakes, because mistakes is inevitable, but to help you make less mistakes in markets. Even after 20, 30 years, even Warren Buffett makes mistake after 50 years of investing, right? So that's part of the game. But in this game, the less mistakes you make, the higher the chances of reaching that, financial freedom mark, and beyond that, higher the chances. So your idea is to make less mistakes, and that's what I'm trying to do with a practical portfolio there, right? So that is a whole game plan A. Now, investing in stock, I said, cannot be taught theoretically alone. It can be taught theoretically, but that's not sufficient. You need to be practically doing that, right? So with more experience you gain, with more mistakes you make, more learnings you have, the better investor you become. That's all I would say. This is not a silver bullet. This course will not help you. This is not a get rich quick scheme. Sorry. And your path to financial freedom takes 20 years, 25 years. If you're lucky, you can get it 10 years, 12 years, like mine. But it is highly dependent, and it depends on how much capital you start with, all of that, right? So investing in stocks is not a guaranteed returns in short term, but in long term, to great extent, a 15% to 20% compounding is possible. If you are a prudent investor, disciplined investor with commitment, you keep learning, make less mistakes, your possibility of achieving 20% CAGR is almost certain, right? But if you're longer path, taking longer path, which is game plan B, the compounding becomes 10 to 12%. And believe me, there's a significant difference between the two over long term. But anyways, if you are interested in to become an investor, if you're interested in investing in stocks directly, this game plan is for you. Go slow. This is going to become a lot of materials. And if you already have accounting background, if you're already an investor in the market, this might be an easy ride for you. Many things you will learn, many things you are already aware of it. So I'm not promising anything new for you. But at the same time, it is something you have to practice by putting your real money out there in the market, right? So I have covered all that aspect. Let us get into the presentation. So there are 6 modules, as I said, and end of it, you will have your action items and reference materials. And in between, I would keep bringing up the reference materials as well, right? So let me start with module 1. Now, the important thing is, for people who are beginners in investing, it's ideal to go through module 1 through 6 in a flow. And for people who are already aware of all these fundamental analysis, but you want to specifically focus on an area, please feel free to skip to the relevant module in the app. Now, let me start with module 1, which is intro into equity investing and 5-step game plan A process. So I have given a 5-step blueprint, which is for game plan A, to follow game plan A. It's very easy. Module 2 is total addressable markets, business analysis, and introducing you to fundamental analysis. Module 3, balance sheet, income statements, and cash flow statements. Now, module 3 is going to be a super long session because there is no other way I could categorically combine it or modularize it. So the 3 main equations of company's financial statements is these 3. So module 3 will be long. Module 4 is capital allocations and management, which is one of the most critical aspects of fundamental analysis. Module 5 is valuations, which is again a very important thing in investing. Module 6 is momentum and selling. Module after that is reference materials, right? Now, let me put this in the slideshow mode. Now, how do you know if picking stocks is right for you? This is another important thing. Some people are not, wired to pick stocks or wired to be investors in stocks directly, but still want to play the game of investing through equities, for whom I have created game plan B. So I have put a self-assessment questions. And at the end of this, if you think you are not a fit person to follow game plan A, you can feel free to go to game plan B directly. So what are those questions? First one, what companies excite you? Does talking about business and companies excite you? I would rather put it that way. What businesses do you know? Your circle of competence. So that is very important. And the key thing you need to take away is the most misunderstood concept there in about myth about investing in stocks directly is people think they need to know a wide range of industries to benefit from getting high returns. It's not that. You don't need to know many industries to make money in the stock markets. I know there are super investors who are focused only in 1 or 2 sessions. People who only invest in banks and make money. People who only invest in consumer stocks makes money. There are different ways to skin the cat. Third one, do you like learning about businesses and companies and reading through their annual reports, balance sheets, and listening to earnings conference calls? Now, if you've not done any of this and you still don't know the answer, it's okay. You will figure it out as the course progresses. Now, if you have an answer for the first two questions and yes to the third question, it should be like if you have an answer as no to the first two questions and yes to the third question, then you can start investing equities through game plan A, which is DIY, do it yourself mode, DIY mode. And the reason being, if you say yes to the third question that you like about businesses, you are interested talking about technologies, businesses, annual reports, earnings, stock markets excite you, then game plan A is for you. And you don't have to worry about the first two questions because I'll tell you how to figure that out. Now, if the answer is no, that is to the third question, that you don't like to talk about businesses, stocks, and all that, please go to game plan B immediately. Now, that is game plan B is nothing but dollar cost averaging strategy. Now, that's a very interesting strategy again. That works beautifully. For people who want to avoid this picking stocks, you don't have time to analyze, you don't know how to analyze, you don't have the interest to analyze. If the answer is any of that, then you don't have to worry. Game plan B works. Dollar cost averaging strategy works beautifully for everyone. But the only problem is it's a longer path, right? So what is circle of competence? This is defined by Warren Buffett, and I'm just bringing that concept here. It's nothing but it's a circle which you define for yourself, where within the circle is industries and businesses that you can understand. And outside the circle is what you think you might know or what you think you don't know. That is outside the circle of competence. What Warren Buffett said is, know your circle of competence and stick within it. The size of the circle is not very important. Knowing its boundaries, however, is vital. So I will differ slightly here. The concept is great about circle of competence. It's a great idea to play within your circle of competence, within your competence, not only in investing in any matter in life, any field. It's a good idea to play around, stick to your competence. And but it's always a good idea. You can try to enhance your circle of competence. It doesn't hurt to increase that circle of competence, because you never know unless you explore. So just because you have not learned about it and not tried it, it doesn't mean that you don't understand it. So it is a good idea to test the waters and try to enhance the circle of competence, because in today's world, there is so much information out there. There is so much of accessibility out there with internet and everything through the apps. So you might be able to increase your circle of competence a little more broader, more than you think. So, but the idea is to play within your competence. Now, let's get into the investor's manifesto, which I have created here. Now, this is applicable, this is timeless, whichever part of the world you take. At many points of time, you might think this is out of fashion, but it'll come back to fashion, on and off. First point is, investing in equity cannot be taught in few hours, but the process of becoming a good investor can be taught, which is what I'm trying to do. The process, knowledge, the steps, blueprint, reference materials, whatever I can, I'm doing that in this session over a few hours. But the whole process of investing equities and mastering that is multi-decadal journey. It's a game of temperament than a game of skills or intelligence. That's the beauty of game of investing, because if the temperament is something you're wired with, then your chance of winning in this game is very high. Stock picking is a combination of art, science, psychology, finance. I put in whatever I know. There could be much beyond this. It could have physics, whatever, chemistry. It's a multi-spectrum industry. You need to know many, many fields. Effort is not proportional to returns. I told this in the beginning. Mistakes cannot be avoided. Even the best of the investors and so-called masters make so many mistakes after decades of experience. Equity investing cannot be learned theoretically with a playbook or a manual. It is like cooking. painting, music, driving, many other forms which can only be mastered through continuous practice and learning because it has art in it. As much as science and math and everything, probability and a lot of other things, it also has a lot of art part to it. And with more practice, like driving, cooking, singing, music, painting, investing is also in that category. More practice, you tend to become better over experience. There are many ways to freedom in equities. As I said, no one method is right or wrong. I explained this in the beginning. Investors make 70 to 80% of wealth, the total wealth in your complete investing lifespan, from 20 to 30% of stocks. So the 80-20 rule, pretty much Pareto rule applies here, over 2 to 3 decades. So returns from few winners in your portfolio can beat the losers in your portfolio by large order of magnitude. And do not invest in equities if you don't have a long-term view of at least 5 years or 10 years, and do not invest the money you need in the next 3 years in equities. If you need the money for within next 3 years, like you have to sponsor your kids' education, something, do not put that money in equities. You only put the money that you don't need, ideally for 5 years, but preferably for 3 years. Only that you have to put in equities. So these are some of the key things I want to put in as a manifesto before we get into the next steps. Now, I will explain game plan A, how to find stock ideas. I mean, it might sound counterintuitive because I've not even explained the fundamental analysis and other things, but let me just make it more interesting by putting a 2-minute video. It's an animated video. I've tried my hand at. I'm not good at the animation, but I thought I'll make it as interesting as possible than making it try. So this animated video of 2 minutes will explain how you can pick stocks. And this is nothing new I am putting. The concept is derived from Peter Lynch's concept, which is anybody can invest in stocks. Peter Lynch was a strong proponent who believed that anybody can pick stocks. What you see is what you invest in. That was his propaganda. And I followed that. Luckily, I read the book, One Upon a Wall Street first. And in that, he beautifully explained how you can invest in things that you see around, right? So you could even show this to your kids, because if you want your kids to start early in investing, you can see this video and see how to generate ideas and how to be a keen observer. But let's get into this video. Now, before I play this video, let me just introduce you to the characters of this movie. It's Robin, Annie, and their son, Rod. It's the day in their life from morning to night and what all activities they are involved in. And your aim, I'm going to walk you through this. I'll give my sound at the background, what they're trying to do in a day. And I'll bring up the different products and services and businesses and activities they do. Your idea is to look for the stock ideas in this video. Okay. Let me start. Robin starts with the day with a phone, like all of us. Brushes his teeth with Colgate, shaves with Gillette foam, ready to eat breakfast after taking bath, and eating Kellogg's Frosties, Kraft macaroni cheese, and Heinz sauce on the sides. Then he gets ready to go to office. He says hi to his son. His son is playing Roblox, and he says hi, and then he puts his new shoes he bought from Amazon. His wife, Annie, is wearing Lululemon and Nike. She's ready to attend Zoom meeting. She's working from home. He says bye and he walks out to see he has to put fuel to his car, Chevrolet car, and then he decides why not, it's time to change to an electric vehicle like Tesla. But still takes a car, Chevrolet out, and goes to petrol bunk and Chevron to fill the gas, and then he goes to Krispy Kreme donuts to pick donuts for his break and a Starbucks coffee to have it at desk, paid with PayPal. Reached office and he got a message during the break from Lemonade about insurance. And then he made his transfer to his friend through Square Cash App. And he made his investment adjustments for the month with SoFi. He is working on healthcare sector. He's doing his CRM integration on cloud with Azure, Microsoft Azure Cloud. He has a Samsung phone on his side, the office phone, and he's completing his Viva CRM cloud. After that, during break, his colleague says she found something interesting about an interesting personal loan offer from Upstart, which helped her to do the home renovation and they had pretty good offers. He says, okay. Then he goes on to the pantry to pick Active popcorn and Nestle water. And he reaches his desk. During the break, his wife sends a snapshot of paint colors for his home from Pinterest snapshot about Sherwin-Williams. Lunch break, picks Burger King and Coke. At the end of the day, he is driving down back. On the way, he picks things from Walmart and Home Depot for his house. And once he reaches home, he's working his Peloton, Spotify, he's listening to music, and also, he's having Celsius drink, energy drink. The end of it, they're watching TV, Netflix through Roku, and contemplating on what to eat. Son wants Domino's pizza, but ends up ordering DoorDash and goes to sleep. The family goes to sleep in their Casper bed. That's the end of the day. So hope you enjoyed that video, 2 minutes animated video, whatever I could do best in my potential in the animation, I did that. So the idea is to bring in anybody's life. You could be the Robin, I could be the Robin. We all see so many things around us. You could be the Annie, you could even be the Raul who grows up to become good stock picker. So anybody in the family, anyone can do this, picking stocks. It's all around us. It's just that we need to be observing all around us, what works, what is not working. We can see, for example, Roblox is in a rage. We all saw that during the downtime in 2021 and 2020 years, most of the people were logging in through Zoom. How much demand was there, right? So businesses and products, businesses are nothing but products and services that we all use every day. And we need to just be a good observer to be a good stock picker. That's the first thing we need. Now let's get into the other aspects. Let me share back my other slides. Now, the most important differences between retail investors. We all are retail investors who are independently doing it for our own portfolio. And then there are fund managers who are doing, they are the professionals, they are the experts who are doing day in, day out, managing money for others, all right? So the advantages of retail investors who are picking stocks directly over professional money managers. There are many advantages. And most of the advantages exist with the retail side. So let me give that positive, happy news. So the first point is investment horizon. So fund managers and professional investors out there are always measured by their performance yearly and sometimes even quarterly. And fund managers has to think in terms of quarters. And biggest advantage a retail investor has over a professional fund manager is time. We all have enough time runway ahead of us to invest in stocks. So retail investors can think in terms of decades, in terms of stock holdings. If you are invested in a stock and a portfolio of stocks, if it does not perform well for 1 year, 2 years, and it doesn't beat the market, you're okay. I mean, you don't have to prove anything to anybody outside there. Nobody's measuring your performance. So you could continue to hold for long periods of time. And if you have the conviction, it is a great advantage that retail investors has, the time horizon. Second is performance benchmarking. Underperformance any year is not encouraged for fund managers because they are paid to outperform year on year, quarter on quarter. And in these days, digital days, fund managers are measured. It's very difficult situation, and it's really difficult for people to outperform every quarter, every year, right? So the underperformance any year is not encouraged, and always needs to create short-term returns to create alpha over the index. That is the hidden mandate out there for the managers. Retail investors can underperform, as I said, for a couple of years. It's fine. In fact, this is common with retail investors due to the nature of the portfolio construct. You will understand later why. Portfolio size. So fund managers will have to manage billions or even trillions of money these days. So they have to invest in large or mid-sized companies. That's why you don't see many analyst coverages for stocks with market capitalization less than usually $1 billion in US and even smaller in other countries. So retail investors can invest in small companies, micro-sized companies with high growth, which can help compound your portfolio faster. Allocation limits. Professional fund managers and funds are governed by regulatory mandates and set forth by the statutory organizations. These rules set the limits to the percentage of shares the fund managers can hold in a company or a fund can hold in a company, or even exposure to the limitations in exposure to certain sectors. They need to have a wide diversifications across different size of the companies, different sectors of companies they can allocate to. These days, it's getting a little more easier and liberal in terms of the norms, but still they are governed by a lot of regulatory overhangs. But retail investors, we have no any restrictions as like that. We could buy small micro cap companies. You can allocate even 25-30% of your portfolio in one stock or a couple, and even 50% of portfolio to the same sector. So there are no such limitations that we have. Bull and bear markets. Rising markets will attract a lot of money to all ETFs and funds, whether actively managed, passively managed. So fund managers have no choice but to accommodate this inflow of money, because they exist for, that's the service they're doing, and buy stocks at higher prices because there is no other options for the dearth of options. And conversely, have to sell stocks to fund the investor redemptions when stock prices are falling. That's another, on both sides there are issues on the bull market and bear markets. But for retail investors, can do the exact opposite. You could buy when the stocks are falling, and you could sell when it's at highs, lifetime highs. And so the market, ideal condition is that, where you need to capitalize on the bear and bull markets. So that is another advantage. So overall, a lot of advantage for retail investors, but there are many other disadvantages which are not called out here, which are really trivial in terms of investing, because one could be the exposure or the accessibility to companies directly, because large fund houses have direct access to many of the companies, and they can get a lot of information in their discussions, and many other advantages they have. But primarily these advantages overrule any other things that fund managers have. Now, the stock market's trends and pricing. So market trend is a perceived tendency of financial markets to move in a particular direction over time. Bull markets and bear markets are a part of the stock market life cycle. I need to introduce you to stock markets and how the trends play out, and what is called bull market and bear market, very high level, because it is important. And most important takeaway about markets behavior is market always prices in the future, that is the outlook. And markets are most of the time rightly priced in the right zones, but often markets can get into the crazy zones, and it's always pricing in the future ahead, which means that the pricing in, as in the stock prices, would reflect the future prospects of a company or of the country, of the market conditions, economy, whatever that is. Now, bull markets, bear market, this is a key thing. You might be already aware of it, people who are in stock markets, but let me just quickly cover this for people who are not involved or heard about this. So a bull market is a rising market. Optimism leading to extreme greed. It's usually optimism that is prevalent in bull markets, sometimes goes into the extreme greed factors. Overall conditions of the economy are sanguine, which means bullish. Companies are growing well, countries are growing well, GDPs are growing well, employment is high. All conditions are great. Most important, the outlook for the markets are sanguine. So bull markets, the outlook is sanguine, bullish. That is why it's called bull market. And the bull markets climbs the wall of fire. We'll get into that. Bear markets are falling markets. The opposites are all true for bear markets. Extreme pessimism or even slight pessimism can lead into extreme fear and panic. Overall conditions of economy is gloomy. Companies are not growing, making losses, or the prospects are looking like they're going to make losses. Employment is low, GDP is falling, or market conditions are scary. Outlook for the markets are extremely bearish. So examples of bull market, we had many in past. It's a good idea to go through all this. I have not covered all those here. Roaring 20s till 1929. The Japanese bull market in 1987. Nikkei market, we hit a high in 1987. Then NASDAQ bull market, the tech stock exchange in US, hit the bull market in 2000, from late 90s to 2000. It peaked in 2000. Then emerging markets, bull market in 2003 to 7. You had longest bull market, which is still continuing in 2020-21, which was 2009 to 2020, but ideally this would be 2013-14 to 2020. It's not from 2009, because there were periods of volatility. And uh, this bull market ended in 2020 with the pandemic, and then 2021 there is a 20 end of 2020 the new cycle has started again. Now, examples of bear market, the Great Depression. One important interesting thing you could see is every bull market has ended up following a bear market. It's typically the sign, and sometimes other way, like bear markets followed by bull market. So that's a cycles rotate. So Great Depression 1930, after the roaring 20s bull market in 1929, it ended in Great Depression in 1930. 1997 Asian financial crisis was a big bear market in Asia, specific zone wise. So again, not all bull markets and bear markets needs to be global phenomenon. There could be pockets of geographies where there could be bull markets many times. There could be bear markets, spouts, series of bear markets in different countries, different zones, different continents. So in different sectors. So it is not specific to that country or a global phenomenon. And there could be always bull and bear markets at different parts of the markets, not only in stocks, it could be in commodities, exchanges everywhere. And Nasdaq crash in 2000, following the Nasdaq bull market, global financial crisis, the ending the subprime mortgage crisis that happened in US in 2008, following the global crisis. Then Corona pandemic led crash in March 2020. So that's a brief introduction to bull and bear markets, but let me just give the most important aspect of a bull market. Bull markets are not very frequent phenomenon. They occur once in cycles, like 15 years, once in 10 years, once in 7 years. So it's a rare phenomenon in a lifespan of an investor, which is maybe 30-40 years. You might get 2 or 3 bull markets, or maybe more, 3 or 4, and you need to really capitalize on the bull markets to make real wealth. Real wealth is made in bull markets. You also need to capitalize on the bear markets, because on either extremes, you'll get great opportunities. And if you cannot time it exactly right, but if you're smart enough and you're experienced enough, you will understand from the signs of exuberance and fear, and you can allocate capital accordingly. And being ready, you don't need to exactly get it right. Even if you're in midway of a bull market and you get the rest right, you made it home. Similar on the other side. So just that point you need to keep in mind as an investor. So never waste the opportunities of a bull and a bear markets. So this is what John Templeton said, famous investor, said about bull markets. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So it is a cycle upwards. And human behavior also tend to gyrate between the fear and greed, starting with fear on the pessimism side and extreme greed on the exuberance or euphoria side. So beautifully said by John Templeton. And also I think someone has said about, bull markets usually climb the wall of worry. There's another saying very similar to this. So both are very apt. Now, moving on to the next slide, a quick history of US bear and bull market. So this was the sources First Trust. They put up a beautiful slide. I searched a lot, and I think First Trust has the best slide out there to talk about the history of US bear and bull markets in one slide. So it goes all the way back to 1942 and shows the S&P 500 index total returns. And it shows all the bull markets in blue spikes you could see in the chart, and you could see all the bear markets in the lower yellow spikes or golden orange spikes every time. So you could see how long the bull market's duration it existed, total returns of S&P 500 in each of those bull markets, and total returns in negative returns in each of those bear markets. And I think after 1929, the S&P 500 had the biggest fall multiple times. I mean, as recent as 1 year back, 33% fall. So imagine index can fall 33%, 34%, 50%, in 2008, 52%. And, NASDAQ felt like anything in 2002. That's another index. So the bear markets can have even indexes falling up to 40, 50%. So we should be prepared in mind. So stocks can fall 60, 70, 80, 90% during bear markets. So we need to be prepared enough to go through those kind of turbulences. The most important thing is you don't want to invest at the peak of every blue zone out there. Every blue zone is followed by an orange zone, if you can see there. So every bull market is followed by a bear market. If you entered at that euphoria, like everyone does, and believe me, all of us go through this. We all are carried away by fear and greed. So if you are carried away by the euphoria and out of greed, we invest at the peak of the blue anywhere, our money is sure to lose, because the time it takes to come back is usually in many years. So you don't want to end up investing at the peak of the blue. Rather, you want to invest at the trough of the blue and pretty much not exit. I would say, cash out a bit, book profits a bit, and keep the money ready to capitalize on the opportunity of bear markets. Easily said than done, but it's very difficult to implement.